October 2008. The global financial system is in complete, catastrophic cardiac arrest. Lehman Brothers has collapsed into dust. The credit markets are entirely frozen. Trillions of dollars of human wealth are being systematically vaporized by the hour. The greatest minds on Wall Street are staring at their Bloomberg terminals in absolute, paralyzing terror, realizing they are witnessing the end of the world. Every sector, every stock on the board is bleeding out. But inside this apocalypse, a terrifying anomaly is occurring. While the rest of the world burns, the stock of one company, a bloated, bureaucratic German automaker that makes boring family hatchbacks, is inexplicably defying the laws of financial gravity. It is violently exploding upwards. In exactly 48 hours, Volkswagen stock rips from 210 euros to over 1,000 euros a share. In a matter of hours, this industrial dinosaur briefly becomes the single most valuable corporation on planet Earth, eclipsing ExxonMobil and Apple with a valuation of nearly $400 billion. This was not an economic miracle. This was not a glitch. This was the execution of the most ruthless, mathematically flawless financial ambush in human history. A tiny boutique sports car manufacturer from Stuttgart secretly engineered a financial weapon so devastating it legally incinerated $30 billion of elite Wall Street hedge fund capital in a single weekend. Porsche didn't just survive the 2008 crash. They weaponized the chaos. They forced the smartest billionaires in the room to blindly fund their own destruction. This is the anatomy of a $30 billion trap. This is the exact forensic breakdown of the mother of all short squeezes. To understand how you trap billionaires, you must first understand the bait. By the mid-2000s, Wall Street viewed Porsche as a hyper-efficient money-printing machine. Volkswagen, however, was viewed as a dying, bloated whale. They generated massive revenue, but their profit margins were microscopically thin. They were heavily unionized, overstaffed, and operated with the speed of a rusted government bureaucracy. Worse, Volkswagen was protected by an impenetrable legislative fortress known as the Volkswagen Law of 1960. This law dictated that no single shareholder could exercise more than 20% of the company's voting rights, no matter how much stock they actually owned. Furthermore, the German state of Lower Saxony owned exactly 20.1% of VW. They held permanent, absolute veto power. Their goal wasn't to maximize shareholder value, it was to protect local factory jobs. To Wall Street, Volkswagen was an unacquirable, inefficient mess, a sitting duck that could never be optimized. So, the apex predators of Wall Street did what they do best. They shorted stock. For the layman, short selling is betting on pure destruction. Imagine you want to bet that your neighbor's rare Ferrari is going to crash in value. You don't own the car, so you borrow it from a broker, immediately sell it to a stranger for $300,000 in cash, and you wait. When the market crashes and the car is only worth $100,000, you buy a replacement, return it to the broker, and pocket the $200,000 difference. But the specialists know the fatal, terrifying mathematical flaw of short selling. If you buy a stock, your maximum loss is your initial investment. The stock goes to zero, you lose what you put in. But if you short a stock, and the price goes up instead of down, your potential losses are mathematically infinite. You are legally obligated to buy those shares back and return them, no matter if the price goes to $1,000 or $10,000. You are contractually tied to a burning building. Wall Street was so arrogant, so universally confident that Volkswagen was a dying dinosaur, that they blindly put their heads into the guillotine. Hedge funds aggressively shorted roughly 12% of all available Volkswagen shares. They assumed it was free money. They didn't realize that Wendelin Wiedeking, the ruthless CEO of Porsche, was quietly standing behind them, building a cage. Wiedeking looked at Volkswagen not as a competitor, but as a host to be consumed. He wanted Porsche to swallow the empire. But there was a massive regulatory wall. Under German financial rules, Any entity buying more than 5% of a company's voting stock had to instantly, publicly declare it to the government. If Porsche started openly buying millions of shares on the free market, the alarm would sound. The stock price would skyrocket, making the takeover infinitely too expensive, and the hedge funds would scatter before the trap was set. Vita King needed a stealth bomber. He needed to buy the company like a ghost. So he didn't buy the stock. He bought the shadow of the stock. He found his weapon in the unregulated shadow ledgers of the European derivatives market. The cash-settled call option. This is the exact mechanic that broke Wall Street. Pay very close attention. A standard call option gives you the right to buy a stock at a certain price in the future. But a cash-settled option is completely different. It's a side bet with an investment bank. You aren't taking ownership of the physical stock. You are purely betting on the price movement. If the price goes up, the bank just pays you the difference in pure cash. For the layman, imagine you want to buy an entire city block. But if people know it's you, they will double the price. So instead of buying the houses, you pay a secret, non-refundable deposit to a network of blind accomplices, the investment banks. You secure the right to the cash difference if the property value goes up. For the specialist, because Porsche was technically only going to receive cash and not physical voting shares, German law stated they didn't hold equity. Therefore, they completely bypassed the 5% disclosure thresholds. To the regulators, Porsche was entirely invisible. They owned nothing but paper. But here is the lethal forensic accounting trick. Porsche went to massive investment banks, Merrill Lynch, Morgan Stanley, Goldman Sachs, and secretly bought billions of dollars of these ghost shares. The banks were now exposed to massive, terrifying risk. If VW stock went up, the banks would owe Porsche billions of dollars. Banks absolutely despise naked risk. So, to hedge themselves, the moment they sold the options to Porsche, the banks went directly into the open market and quietly bought the actual, physical Volkswagen shares to keep on their own books. Do you see the architecture of the monopoly? Porsche wasn't buying the company. They were legally forcing the largest banks in the world to hoard Volkswagen's actual stock on Porsche's behalf, locking the shares away in dark vaults. Wall Street was draining the ocean, and the hedge funds swimming in it hadn't even noticed the water level was dropping. For 3 years, Porsche silently built a financial nuclear bomb. And then came the math, the most devastating, inescapable math in modern financial history. Look at this equation. This is the math of absolute destruction. The German state of Lower Saxony owned 20.1% of VW and legally couldn't sell. Index funds held exactly 5%. Porsche explicitly owned 42.6% in real stock, and through their hidden ghost options, they controlled another 31.5%. Added up, 99.1% of the entire Volkswagen empire was completely locked in a vault. Only 0.9% of shares actually existed to be traded on the open market. Now, remember the arrogant hedge funds? They had shorted 12% of the company. To survive, they physically needed to buy 12% of Volkswagen to return the shares they borrowed. But Porsche only left them 0.9%. Imagine 12 billionaires are trapped inside a burning building, but there is only one exit door, and that door is exactly 0.9% wide. And Wendelin Vita King is holding the only key. Sunday, October 26th, 2008. The markets are closed. Wall Street managers are playing golf. Porsche's PR department calmly uploads a brief, 3-paragraph press release to their website. They completely drop the facade. They announce to the world, "We hold 74.1% of Volkswagen. We intend to acquire the company. Short sellers should cover their positions." It was an execution order. Hedge fund managers woke up to the realization that they were dead men walking. They ran the math. They realized the shares they needed simply did not exist. They spent Sunday night in agonizing terror, knowing they were trapped in an infinite mathematical loop, waiting for Monday's opening bell to execute them. Monday morning, the opening bell rings. Pure, unadulterated panic rips through the global banking system. The prime brokers issue mandatory margin calls. The short sellers had to buy back VW shares at literally any price to avoid forced liquidation. They were blindly cannibalizing each other. the trading algorithms broke. Volkswagen stock violently exploded from 210 euros to over 1,000 euros a share. The hedge funds were hemorrhaging billions. Desperate managers had to liquidate their healthy blue-chip stocks just to pay for their Volkswagen losses, dragging the entire global market down even further. Entire funds were literally erased from existence in hours. And who was on the other side of those desperate trades? Porsche. Vita King mercifully offered to sell up to 5% of his shares back to the dying hedge funds just to let them escape. But he sold them at an astronomical, world-ending premium. Porsche used the blood money of their enemies to pay down the massive debt they used to build the trap in the first place. They forced Wall Street to fund its own destruction. Porsche made an estimated 10 to 30 billion euros in paper profit. For a brief moment, they became a hedge fund that occasionally made sports cars. While the 2008 financial crisis eventually made debt too expensive, resulting in Volkswagen technically reverse acquiring Porsche, it was a Trojan horse. The mechanics were already set in stone. The Porsche and Piech families consolidated absolute voting control over the entire Volkswagen group, forming an inescapable automotive monopoly that rules the roads to this day. In the brutal mechanics of money, it doesn't matter how big you are. It doesn't matter how smart Wall Street thinks they are. It only matters who controls the exits.